Hi, I'm Amy Gamper, backstage live at the 2024 Stansberry Conference and Alliance meeting. I'm sitting here with Marco Papich, who is a geomacro strategist, and he just gave a fantastic presentation on the geopolitical trilemma. He specifically focused on China, Russia, and climate change. So we're going to dive a little deeper into that. And welcome, Marco.
Thank you so much, Amy. It's such a pleasure to be back at the Stansberry Conference.
Oh, we're excited to have you here. Thank you so much for being here. We have some questions that live stream viewers are watching that I'm wondering if I can ask you those questions.
Love to. Yeah, of course.
Okay. All right, great. So we can go a little bit further into what you talked about on stage. So my first question is, with the announcement of China's economic stimulus package, the country has garnered increased attention as of late. Can you please explain your thoughts on assets, including Chinese stocks, being priced for imperfection?
It's a great question, Amy, because something strange has been happening in China. For the past, I would say, 4 or 5 years, they've really been suffering from very low growth. And one of the reasons for, at least for their standards, and one of the reasons for that is that China has a secular problem very similar to what the US faced after the great financial crisis. It's actually not that different at all. Real estate prices went up too much. It was a bubble. It collapsed. And the government and the households are now deleveraging. And we know how to fix this. This is a mathematical problem that has been solved by basically prominent economists like Richard Koo. All you need to do when the private sector is deleveraging, the public sector has to step up and make sure the GDP continues to grow. They've been refusing to do that. And a lot of analysts out there try to explain why. And I would just say, well, did we do that after the great financial crisis? The answer is actually no. We printed money, but we didn't spend any. In fact, there was this period of real moral sort of problems. Moral hazard became a huge issue, and the government actually did austerity. If you remember 2010, 11, 12, Obama, Tea Party talking about cutting the budget deficit at the same time that the private sector deleveraged. And that's because after a real estate crisis, it's very difficult to do what the math tells you is correct. Everybody wants to tighten their belt. Everybody knows that they've been naughty, so they want to be sort of, oh, well, we'll be more proper this time around. Unfortunately, what has to happen after a real estate crisis, the government just has to spend money.
Okay.
And they're doing that right now. Now, the news flow hasn't been that bullish, and that's because they're still struggling to shift completely. In my view, we're going to have a 12-month period of piecemeal stimulus. Neither one of them is going to really be that sufficient. But 12 months from now, we're going to look back at it and say oh, wow, that wasn't that bad. Imagine if you started eating a Snicker bar every night. I'm pretty sure that after, maybe we do that
I'd probably
already.
do that, yeah. I know.
But in 12 months' time, you'll look back and be like, this had a difference on my body fat percentage. So
yes.
think of it the same
way. It slowly
way.
creeps up on you.
It's exactly. And so when I say to China and its various assorted assets, associated assets correlated to China, emerging markets, emerging market currencies, commodities, when I say that they're priced for imperfection, what I mean is that China doesn't have to knock it out of the ballpark with a stimulus for you to get excited. Even a piecemeal stimulus delivered drip, drip, drip over the next 6-12 months should be enough. Whereas American assets, US stocks, and US currency are priced for perfection. We need everything to land just right for us to continue to buy, basically like NASDAQ. So that's where I say maybe start nibbling at global assets as an investor. Start taking a flyer on Brazilian company here, EM index there, BCOM over here. Try to just diversify a little bit.
A little bit at a time. Okay,
yeah.
And then it all adds up. Okay, great. In a recent interview, you questioned whether Western policymakers are pursuing too many de-risking policies at the same time. So can you expand on that a bit for our viewers?
For sure, yeah. So that's what the speech was about here at Stansberry Conference. I have this concept that I call the Geopolitical Trilemma. It's not a dilemma. It's not like, should I have coffee or tea in the morning? It's coffee, tea, or Diet Coke. And then you decide, because you can't decide which one to have. You decide to have coffee, tea, and Diet Coke. Well, it's probably a recipe to be very wired that day. There's going to be consequences of pursuing too many policies at the same time. And what I think is happening right now is the West, broadly defined, has decided to de-risk from China, which requires a lot of construction of manufacturing around the world. De-risk from climate change, which requires a lot of construction of various energy systems around the world. And then finally, to de-risk from Russia, which I think will curtail the supply of commodities. So the first two de-risking efforts are increasing the demand. The third one is decreasing supply. So just how should we invest based on this geopolitical concept? Well, don't get too fancy. Don't try to buy defense stocks or specific, there's a war in Ukraine, I want to go long wheat. No. Just step back, look at the big picture, and say, look, we're going to be in a new commodity super cycle because we're doing too many things at the same time, and they all require commodities.
Yeah. I mean, I thought that was the most very interesting thing that you were talking about. Infrastructure is going to be the most important thing, especially with climate change. I mean, that surprised me as.
Yes. Well, so like climate change is interesting. You want to drive an EV because it doesn't have emissions.
Right.
Well, it does take 200 kilograms of metals.
I know. I couldn't believe that.
Right. Internal
More
combustion,
than a normal car.
Internal combustion is 40. And so when you think about something like cobalt, to get the cobalt out of a mine in the Congo and then take it via rail to a port, now you're going to need 10x that. So you need to make another railroad, build more warehouses at the port, maybe dredge the port for bigger ships. And then all of that has to go to China, and it has to go to China because nobody else refines cobalt. And then from there, you're going to have to probably build more warehouses there, maybe expand the refining. So when you think about what goes into this pivot that we've decided to do, it's just so much. It's not just about cobalt, which I would not want anyone to trade, by the way.
Right.
It's a manipulated market by China.
Okay.
So it's not that. Invest in broader assets.
Right.
And one broad asset to do is just buy a broad commodity index that has a piecemeal of all of these things in it, and then also industrials. Because you're going to need machinery to dredge the port, build a warehouse, build a railroad, and so on.
Great. Yeah, that's great to know for the investors, so to think about. Okay, so how do you think the wars in Ukraine and the Middle East are going to progress from here? What's the end game, do you think, for either one of them?
Well, thanks for asking me that, because I didn't get a chance to talk about that.
Yeah,
I wanted to focus on like kind of the longer term. So I have a pretty controversial view on both, I think.
Okay.
On Ukraine, Russia, I would say that as far as the market is concerned, the war has been over for 2 years. So that's what I want to start off with, like the conclusion.
Okay.
And what I mean by that is, let's say the war ends tomorrow. Just tomorrow. There's a peace, everybody agrees. I don't know what to tell my clients how to trade that end of the war. Because the market has moved on. And most people, when you say this to them, they don't believe you. But on September of 2022, there was basically no more alpha to generate by trading the conflict. And so what I did is I asked my team to create 3 maps for me. October 2022, October 23, October 24. I want to see these 3 maps. What do they look like? They look exactly the same. There's very minor changes in borders. And so what I would say is that I think the conflict is exhausted itself. There has been no change in borders for 3 years. We overstate almost everything that goes on. And the reason there hasn't been movement has nothing to do really with politics or geopolitics. Number one, defensive technology is far superior in 2024 to offensive. So it's very difficult to make gains. You can use cheap technology like drones, Javelin, man-portable anti-tank missiles to basically deny access to an area. And then the second thing is that in Russia, everybody talks about their quantitative advantage, but they don't have a qualitative moral advantage. And what I mean by that is that Russians aren't really in this fight all the way. And so it's difficult for Putin to basically rally and mobilize troops to actually win. And so we're in a stalemate. Nothing's going to change that. Too many people index on Trump's presidency as sort of like a moment when the war changes because he ends it. I think the war is going to end by the end of 2025. It's not going to end in a peace deal. There's not going to be a peace. It's just going to end in a ceasefire. The two sides are going to agree to disagree. The Russians are not going to withdraw from these territories. Ukrainians are not going to accept Russian control. And you know what I would say to the viewers is that many wars ended this way. South Korea and North Korea don't recognize each other. Azerbaijan and Armenia didn't recognize Nagorno-Karabakh shift of who was controlling it. Serbia and Kosovo don't recognize each other either. So this is just going to peter out.
Yeah, yeah.
Middle East is a more complicated one.
Yes.
But again, on that front, I would say that I think we overstate the ability of Israel and Iran to have a war against one another. They're far from each other. Unless Xerxes comes back, you know, the emperor of Persia from like 300, unless he comes back, this is going to be a very kind of a fake war. Okay. And what I mean by that is there's going to be a lot of missiles coming one way or the other, and then they're going to exhaust their supply. Let's not forget Israel and Iran are not China and the US. They don't have a non-exhaustible supply of cruise and ballistic missiles. My bigger concern is that after the election, I think the US has to look at the enrichment activity, uranium enrichment by Iran, and will have to take matters into its own hands.
Okay.
You know, so that's something to watch for. And that's why I do think for 12 months I've been telling my clients, don't go long oil. This conflict in the Middle East will not have any impact on investors. Actually, oil went down. I should have shorted it. you know?
Okay.
But going forward, I do think that there could be some geopolitical risk in the markets, just because once the US gets involved, the US can have a war against Iran and can seriously degrade its ability to supply the world with oil. So that's something to watch for next 6 months. No matter who wins the election, there's a crisis coming between US and Iran.
Okay, well, you just brought up the US election. I know the audience, everybody was
waiting
to hear
for me
a little bit more, and they're
Yeah.
all going to pounce on you at the breakout sessions.
That's right.
Or do you want to talk a little bit
sure.
about that?
Well, I had 30 minutes, you know.
Finish
Amy.
it out. No, I know.
For sure.
You covered so much information.
We tried
I was
to-
amazed.
I did have
so
some slides at the end.
Here's a moment.
On the US election. I did promise everyone I would talk
Okay.
about it.
Yeah.
So first of all, I know everybody wants to just hear who's going to win. You know, why you would give any credence to Marko Papic's view, I don't know, but I'm going to give it to you. You know,
Everybody wants to hear.
I'll just throw it. Look, I think I think that if you are Vice President Harris, I think you have a real concern on your hands, and the concern is that in the swing states that decide this election, so Michigan, Wisconsin, Pennsylvania, and then Arizona, Nevada, maybe North Carolina, Georgia as well, you're in a virtual tie with Trump, with President Trump. So Vice President Harris and President Trump are tied. Yeah. Now you might say, okay, well, cool, like it's 50-50, right? You know, in 2016 and 2020, in both of last two elections, both Secretary Clinton and Vice President Biden at the time had a lot of cushion in these states. Not all of them, but in the important ones, especially in the Midwest.
Oh, okay.
So the polls showed both Clinton and Biden leading Trump by 5 to 10% in Wisconsin, Michigan, and Pennsylvania. And then he had the surge at the end in the last week in the polls. Now, why did he have a surge? I don't really know. Maybe, you know, like people become more comfortable saying they will vote for Trump the closer you get to the election. I don't know. But I just know that in the last two elections, you know, which is a sample of two, so let's not overstate it, Trump did really well at the very end. Okay. And so all I would say is, if I had to pick someone to win the election, I mean, I would say that, look, you know, Harris just doesn't have that cushion that I think you need against, you know, Trump. You need a lead. Like if Trump and Harris were horses, you want to have a lead because he's a strong finisher. And so that would be my pick for who wins. Now, in terms of what it means for the markets, because who cares really who wins? Like this is about investing.
Let's talk about the investment aspect.
Yeah, so what I would say is I think Harris' presidency's continuity, it wouldn't really be an interesting investment outcome. I think everything is just sort of stays the same. A lot of investors often say something like, well, Democratic presidents are bad for stocks because they regulate too much. And while it's objectively true that Democratic presidents usually impose more regulation, you can't tell me that stocks didn't like the Biden and Obama presidencies. Like stocks ripped. So I don't really put any credence in that.
Okay.
With Trump, the view is, well, in 2016, all the pundits were, short, and then he surprised them, and it ended up being a really good outcome. I would say yes, but the macro context was completely different in 2016. In 2016, we were facing low growth. We had no inflation. The 10-year yield was at 1.6% when he was elected. It doubled by the time of the midterm elections at 3.2%. So Donald Trump brought growth and inflation. He did pro-cyclical stimulus. Stocks loved it. Stocks loved it because we needed growth. We also even needed inflation in 2016 and 17. We were in a disinflationary context, very painful.
Yeah.
So you can think of Trump as a mean reversion fairy in 2016. In 2024, nobody's long stocks because of growth and inflation.
Okay.
Everyone's long stocks because of soft landing. Growth and inflation are going down.
Okay.
So this is the difference, I think, in my view. In 2016, I was one of the very few bullish people about Trump getting elected. I said, well, I think he'll be great for stocks. We need growth. In 2024, I don't think we need growth. And so what I would say is if Trump gets elected, I think the 10-year yield can go much higher, much more significant, and I think stocks would react negatively to that. Now, one thing I would say is that it's not like there's a difference between Harris and Trump. It's not like Trump will spend more money and Harris will spend less. It's just that I think it's almost inconceivable for Harris to carry Congress. She's going to lose the Senate. I think the math is just clear. And so she'll have a constraint on spending money, whereas he will not.
Yeah.
And so that's where I think the bond market will have a different reaction. And so I worry that bonds will not act as a hedge against equities, and both will come down, but temporarily. This is a buying opportunity. I wouldn't, this isn't the end of America.
Okay.
I think there's just going to be a bond market riot, and then President Trump will have to sit down with his economic team, take into account what happened, and you buy at that point. It's not like it's a recession. It's just a sell-off.
Right. All right. Well, we'll see soon, right?
Yeah. Hopefully.
Yeah.
Hopefully not too long.
Exactly. Well, thank you so much, Marco. Really appreciated sitting down, talking to you, just diving a little deeper into what you were talking about on stage.
Absolutely.
Thanks
It's a real
again.
pleasure. Thank you again for having me.
You're welcome.